Hello again. In this video, I'm going to talk about how to account for customer accounts that are uncollectible. As you know, customer accounts are maintained in an account called accounts receivable, and accounts receivable is an asset. By definition, an asset is something that we own that will give us a probable future economic benefit. Well, we own the right to the accounts receivable because we've already done the work for that. That's why the customers owe us the money. And it's a probable future benefit because we probably will collect it. What do you do if you identify a customer account that's uncollectible? Maybe we've discovered that customer has gone out of business. Maybe we discover they've gone to prison. Maybe we've been in communication with them trying to collect the money, and they have flat out told us they're not happy with the work that we did and they're not going to pay. So we've identified a customer account that no longer has a future benefit. Well, what do you do with any asset when it loses its future benefit? Prepaid rent. As that rent expires, we record rent expense. We lower the asset and we record rent expense. We have supplies, which is an asset, and as we use up those supplies, then we're going to record supplies expense. Equipment that we purchase that lasts us for multiple periods, but as that benefit expires, we record depreciation expense. So any asset, when it loses its future benefit, we record some sort of an expense to show that that benefit has expired. We expense it. With accounts receivable, when we identify a bad customer account, we're going to record bad debts expense. Bad debt expense represents the uncollectible customer accounts that have lost their future benefit. So let me look at a specific example with that. There's actually two ways to deal with customer accounts that are uncollectible. The first method is called the direct write-off method. It's kind of the most straightforward. If we identify a bad customer account, we're just going to write it off to bad debt expense. For example, let's say we have $20,000 of accounts receivable in total. Now we know that doesn't represent just one big customer. It represents a whole bunch of individual customer accounts that are added together. Well, we're going to keep up with all those individual customer accounts in what's called the accounts receivable subsidiary ledger. So the subledger keeps up with individual customer balances, and if you added all those together, it would equal the balance in the accounts receivable account. So the ledger account, accounts receivable, is considered the control account because it keeps up with the control total, and the subledger keeps up with the details. Okay, so we have customer totals adding up to $20,000. Let's say we have one customer, Clayton, who owes us $200, and we have determined that Clayton is never going to pay us. So we're ready to write it off. To write it off, we're going to simply credit accounts receivable for the $200 and debit bad debt expense. And when we record that, when we post it, the debit will go to bad debt expense and the credit will go to accounts receivable, giving us a balance of $19,800. So that $19,800 goes on to the balance sheet, and the bad debt expense, representing that account that we wrote off, goes to the income statement. And in Clayton's account, by the way, when we credit accounts receivable, the total, we also need to update the individual customer account that was related to that. So we would credit Clayton's account for that $200, and in big red letters we would put wrote because we want to make sure that when we look at his account, we don't think it's zero because he paid us, but we flag it so we know this is not a good account. If Clayton comes back in to buy on credit, then we're not going to do that because we can look it up and we can see that he didn't pay us the last time. So when we identify under the direct write-off method, when we identify a customer account as uncollectible, we simply write it off to bad debt expense. The other method is called the allowance method. And under the allowance method, when we get to the end of the year, let me just kind of back up here a second. Okay, so let me back up just a second here. Suppose we have $20,000 of accounts receivable, and we get to the end of the year, and we're about to make some financial statements. And we have a pretty good idea that some customers aren't going to pay us. Now, we don't know who it is, but we're pretty sure that $20,000 is not really a future benefit. We think some folks are not going to pay us. So if we put $20,000 onto the balance sheet, indicating, hey, this is our future benefit, that would actually be a little overly optimistic in terms of what we expect to collect, and that might give overly optimistic expectations to individuals who are thinking about investing in our company. So under the rules of accounting, we try to avoid being overly optimistic like that. You might even say we try to be conservative, or at least be realistic about our expectations. So let me get over here to this next page. What we're going to do, here we have this $20,000 of accounts receivable. But before we put it on the financial statements, well, here it is. Here's the balance sheet, $20,000 of accounts receivable. But we're going to come up with some sort of an estimate. We're going to call this an allowance for doubtful accounts. We're going to estimate how much of that $20,000 is uncollectible and reduce the $20,000 to that collectible portion. Now, in order to estimate that, one thing we might do is look at the customer balances and figure out how old they are and trying to estimate the quality of those receivables. So what I've done over here, I have what's called an aging of accounts receivable. If you take all of these individual customer balances in the accounts receivable subsidiary ledger, and you list them out, and then kind of age them, show how old they are, then you can get a sense of the quality of these receivables. If most of those receivable balances are brand new, then we would consider that to be good quality. But if we have a whole bunch of really old accounts in there, then there may be a problem with collectability. So I've got these customer balances aged, and most of them are current. And let's say that of the current balances, we think maybe 1% of those is uncollectible. And then we have some other accounts that are between 31 and 60 days old, and we're estimating 5% of them is uncollectible. And then a few other accounts, 61 to 90 days old, we'll apply 10% to that. And then of the really old accounts, out there over 90 days old, we're thinking maybe half of that amount will not be collected. So when we multiply out those percentages by the different age groups, and then add up those subtotals, we get a total estimate of a little over $1,000 that we think is going to be uncollectible. Now this is just an estimate, nothing. We're trying to be as accurate as we can, but it's still just an estimate. So let's decide, we'll just kind of round that off, and we're going to record $1,000 as our estimate. This is an end-of-year adjusting entry. We're going to debit bad debt expense for the $1,000 and credit this allowance account, which is a contra asset account. These two accounts, accounts receivable and the allowance account, they go hand in hand. That $1,000 credit balance is there for the purpose of offsetting that $20,000 of accounts receivable, and the two are reported together on the balance sheet. So now we're going to report $19,000 as a net accounts receivable on the balance sheet, indicating this is what we really think is our future benefit. Now you'll notice when we credited the allowance account, which brings down the accounts receivable, we are recording bad debt expense at that time. So under the allowance method, we don't record bad debt expense when we write off an account. We're going to estimate that at the end of the year, set up this allowance account, and then when we identify an actual bad account, we're going to write it off against the estimate. So for example, let's say, so we did this first adjusting entry at the end of year one. And then the balance sheet showed $19,000 of net accounts receivable, $20,000 total minus the allowance of $1,000. And the bad debt expense on the income statement was also $1,000, subtracted along with all the other expenses. The bad debt expense, of course, would be closed at the end of the year, but not the allowance account. The allowance account is not a temporary account. Now we go into year two. Let's say that at some point during year two, we decide that Clayton is not going to pay us. That's just an uncollectible account. So we're going to write it off. Well, in the previous example, we wrote it off to bad debt expense, but under the allowance method, we've already recorded the expense. We're going to write it off against the estimate, the allowance. So the debit will go for $200, would go to the allowance account, and the credit to accounts receivable. So now when I post that to the ledger, the $200 goes here, leaving $800 in the allowance account. And then the credit goes to accounts receivable, $200, leaving $19,800 as a balance in accounts receivable. Now remember, when we credit accounts receivable, we also have to credit the individual customer that we're talking about. So we would write off Clayton's account, and again, we would designate his account as written off so that we don't look at that as a good account. It's zero because it was written off. So let me just kind of summarize that, and then we're going to look at a little more in-depth example. At the end of the year, we look at our accounts receivable, and we estimate how much of that is going to be uncollectible. And we record an adjusting entry to set up an allowance account for that estimate. The debit goes to bad debt expense. Under the allowance method, the only time you touch bad debt expense is when you're making this end-of-year adjusting entry. So we set up the allowance account, and of course the expense account went to the income statement and then was closed. And then when you write off an actual account, you're writing it off against the estimate. If your estimate, in this case of $1,000, was perfect, then during the next year, you would write off exactly $1,000 and get it down to zero, and then at the end of the year, you would do another adjusting entry to reestablish that allowance account. The chances are it's not going to be perfect. chances are that $1,000 estimate we made at the end of year one is going to be too high or too low. And so we're going to look at a little more in-depth example on the next tab to show what to do in those circumstances. So here I've got a few more transactions that we're going to go through. So again, we have $20,000 of accounts receivable. Now we get to the end of the first year, we estimate that $1,000 is uncollectible, just like we talked about before. So remember, the end of year adjusting journal entry is always debit bad debt expense for $1,000, or debit bad debt expense and credit the allowance account. So the expense will show up on the income statement, and the allowance account of $1,000 will show up on the balance sheet. So over here, I have the financial statements and how they're going to appear. So again, at the end of year one, we have a net accounts receivable of $19,000 and bad debt expense of $1,000. Then we're going to close the bad debt expense account and get into the second year. So let's go with that. We provided $90,000 of services on account. Well, we're going to debit accounts receivable and credit revenues for $90,000. And the debit, we're only going to keep up with the the account receivable part on this. So accounts receivable is debited for $90,000. And remember, anytime we put something into accounts receivable, we have to update who that is. And in this case, let's just say all that went to the other category, other customers. Okay, in the next transaction, we collected $85,000 from customers. So that would be a debit, $85,000, a cash, and a credit to accounts receivable. So the debit goes to the cash account, and the credit would go to accounts receivable. And of course, anytime we credit accounts receivable, we have to credit individual customers, and I'm going to put that into this other category. So again, anytime you add up the detailed individual, anytime you add up all those customer accounts in the subsidiary ledger, it should add up to whatever's in this account here. Let me set this up just a second. Okay, so I've got the accounts receivable updating for as we put entries into it. Transaction C, now we've identified some actual customer accounts that are uncollectible. In this case, $1,300. Now remember, we set up an allowance for $1,000, and that was an estimate, but now we've identified $1,300 as actual customer accounts that we're going to write it off. Well, we're going to write them off against the allowance account. So debit the allowance for $1,300 and credit accounts receivable for $1,300. And when we post that, the debit goes here, the credit goes to accounts receivable, and remember, we also have to record what customer that is. So let's say that 1,100 of it went to this other customer category, and $200 went to Clayton. And as before, we are going to write off Clayton's account. So we wrote off a total of $1,300, and notice we did not debit bad debt expense. As I said a minute ago, the only time we touch bad debt expense is when we set up the end of period allowance estimate, so in our adjusting journal entry. So we're going to do that again when we get to the end of year 2 here in just a minute. So we wrote off $1,300. Now, every now and then you might have a customer that you had already written off come in and pay you. So what do you do in that case? It might be pretty rare, but let's say that Clayton comes in real apologetic and says, man, I'm really sorry that it took me so long to pay you. I just fell into some hard times, but I want to get my account back into a good standing with you, so here's the $200 that I owe you. Well, so of course we're going to be very thankful that they brought that in, but now we've got to figure out how to record it. Well, the first thing we want to do is reverse the write-off. That will reinstate his account as a good account. So to reverse it, we're just going to reverse what we did up here. So debit accounts receivable for the $200 and credit the allowance account. Now when we do that, the debit to accounts receivable goes up here and the credit to the allowance. And remember, anytime we do something to accounts receivable, we have to do it to the detail, and so we're going to debit Clayton's account for $200, and now his account is set back in with a debit balance. And, of course, he just paid us, so we need to record the collection. So we'll debit cash and credit accounts receivable. And so the credit to accounts receivable is posted up here, and also to Clayton's account. And now his account is back to zero, but not because we wrote it off, but because he's actually paid in full. And we may want to just go ahead and recognize that. And that way we can actually see that that's a good customer, a good balance again. You might wonder, well, why did we debit accounts receivable and credit accounts receivable all in the same transaction? And the reason is because we want to run this through his account. So in order to run it through his account, we have to debit accounts receivable first for the reinstatement, and then credit accounts receivable to show the collection. So that might be a rare circumstance. If you generally aren't going to write off a customer account until it's really old and you're just ready to give up on it, and there's very little chance of it ever being collected. But if it does happen, then we would reinstate the account first and then show the collection. Okay, so now we've gone all the way through year 2. Let's see where we are. We have an ending balance of in accounts receivable of $23,700. And the balance in the allowance account now is, we had $1,200 here, offset by $1,300. We have a $100 debit balance in the allowance account. Remember, we had initially put $1,000 in there. Well, it turns out, after everything is said and done, that we used up more, we wrote off more than the initial estimate. So that gave us a debit balance in there. Okay, so we get to the end of the year, we're going to estimate how much of the ending balance is uncollectible. Let's say we estimated 10% of this $23,700 is uncollectible. And maybe we got to that 10% by going through an aging schedule like we illustrated a minute ago. Well, 10% of that ending balance would be $23.70. So we think that of the 23,700 accounts receivable, we think $23.70 is uncollectible. That means we want $23.70 to be in this account. Well, to get there, we're going to have to offset the 100 first, plus put the $23.70 in. So that we're going to have to credit the allowance account by $24.70 in order to get there. So the adjusting entry to hit our target, when we did this calculation here, that became the target that we want in the allowance account. And now we're going to make a journal entry to hit that target. That's going to be debiting bad debt expense for $24.70 and crediting the allowance. And when we post that to the ledger, the bad debt expense, $24.70, is here, and the credit to the allowance account of $24.70 now brings the ending balance. It swings that 100 back over and gives us an ending balance. I'll show you how it adds up. It'd be that $24.70 offset by that 100 over there. So $23.70 is the ending balance in the allowance account, which is what we were after, 10% of that $23,700. So in the financial statements, at the end of the second year, we have the $23,700 accounts receivable offset by the allowance, and the bad debt expense is going to be $24.70. Now remember, that's because last year we underestimated how much our allowance needed to be, and so we had to expense a little extra this year in order to hit the target that we were after. So the underestimate from last year is offset by expensing a little extra this year. If it had been just the opposite, if we had anything left over as a credit to the allowance account, if we had overestimated last year, then that would reduce how much we would need to make the adjustment for here at the end of year 2. So that's how to account for uncollectible customer accounts. We did the direct write-off method first, where you take the accounts receivable directly to bad debt expense. The second approach is the allowance method. Under the allowance method, we analyze at the end of the year. We look at the accounts receivable, we estimate how much is uncollectible, and we set up an allowance account for that amount. And if something is already in the allowance account, then we would have to take that into consideration as we're calculating the adjusting entry, because we want to hit that target, that estimate that we had developed. And the end of year adjusting entry is always bad debt expense debit and credit the allowance account. And in that adjusting entry at the end of the year, that's the only time we touch bad debt expense. Okay. Work some practice problems with that.